All right, let's jump right into this explainer. Today, we're putting on our sell-side equity analyst hats to initiate some rigorous, fundamental coverage on Netflix. If you want to understand the true intrinsic value of a company, you absolutely have to look past the daily stock price noise. You've got to dig directly into the filings, the operating segments, and the cash flow statements. So we are building a fundamental valuation of the world's leading streaming service, completely grounded in their actual business reality. Whether you're an active investor or you just want to know how Wall Street actually values media giants, this is your masterclass. Okay, you literally can't talk about Netflix without starting with this absolutely massive number. They ended 2025 with over 325 million global paid subscribers. This sheer scale is the absolute bedrock of our valuation. When we're estimating long-term revenue growth and calculating that terminal value, it all starts right here, with the sheer size of the audience they can actually monetize.
Now, the catalyst for this recent surge? It's honestly fascinating. You know that password sharing crackdown everyone complained about? Well, from a purely financial modeling perspective, it was an absolute masterstroke. Forcing an end to password sharing added roughly 50 million net subscribers between late 2023 and the end of 2024. It completely revived their financial trajectory and vastly expanded their addressable base, especially for the new ad-supported tier.
So here's our roadmap for today's valuation. We'll quickly hit the business model and moat, break down the global segments, check the cash flow and margins, dive into the actual valuation multiples and our DCF model, and finally, weigh the future growth and risks. Let's get to it.
Starting us off, Section 1, Business Model and Moat.
Netflix's competitive moat isn't just about throwing billions of dollars at original content anymore. I mean, sure, with nearly 62% of their US catalog being original or exclusive, they definitely have depth. But what fundamentally changes their business risk profile today is that ad-supported tier. It serves as this brilliant structural downgrade path. Basically, instead of outright canceling when money gets tight, users just switch to the cheaper ad tier. Plus, management notes they are still under 45% penetrated across 800 million global smart TV households. That proves their core product is still very much in a growth phase, leaving a ton of headroom to capture global viewing share. Moving right along to part 2, global segments and subscribers. The momentum here is just staggering. By the end of 2025, they cruised past 325 million total paid subscribers. But here is the most vital data point for our forecast. 113.2 million of those subscribers, so nearly 35%, are now on the ad-supported tier. This rapid adoption provides a whole new, massive vector for revenue growth that goes way beyond just raising standard subscription prices. Now, as analysts, we have to map out customer dependency, right? So look at the geographic concentration. While the EMEA region, that's Europe, Middle East, and Africa, actually has the highest volume with over 101 million subscribers, the US and Canada remain the undisputed revenue engine. They command an average revenue per user, or ARPU, of $17.26. Meanwhile, the Asia-Pacific region is their fastest-growing geography, but sits at an ARPU of just $7.34. This segment structure is deeply important for how we model future revenue margins.
All right, Part 3, Cash Flow and Margins.
Here's where things get really fun, because we can trace the bridge directly from revenue down to free cash flow. In 2025, Netflix generated $45.2 billion in revenue. This massive top-line scale easily outpaced their roughly $18 billion cash spend on content, which results in structurally higher free cash flow margins. The big takeaway? They are no longer burning cash to build the library. The library is now generating massive amounts of cash.
Plus, those ad-tier viewing dynamics we talked about, they are translating directly to the bottom line. By capturing audiences that are increasingly unreachable by traditional commercial TV, Netflix pulled in over $1.5 billion in ad revenue in 2025 alone. And according to management's own guidance, they expect that figure to roughly double in 2026. That is highly accretive to operating margins.
Okay, before we build our actual forecast models, just look at these rapid-fire efficiency metrics. They prove Netflix is a highly capital-efficient machine. An operating margin nearing 30% is fantastic for a media company, but it's that phenomenal 33.12% return on invested capital that really stands out to me. It means for every single dollar Netflix reinvests back into its business, whether that's in tech or new shows, it is generating substantial excess returns.
Which brings us to the main event, Part 4, Valuation, looking at multiples and our DCF model.
Let's walk step by step through the derivation of our unlevered free cash flow.
This is the absolute lifeblood of fundamental analysis. We start with roughly $13.9 billion in operating profit, take out our 16.7% effective tax rate, add back non-cash expenses like depreciation and amortization, and then deduct capital expenditures and working capital changes. This waterfall calculation leaves us with a massive $11.89 billion in actual, tangible, unlevered free cash flow.
Now, to figure out what those future cash flows are actually worth in today's dollars, we need a solid discount rate, factoring in Netflix's historical stock volatility against the broader market, giving us a beta of 1.55, alongside their stable debt-to-equity ratio of 0.54, we calculate a weighted average cost of capital, or WACC, of 12.39%. Think of this as the internal hurdle rate their cash flows must clear to create actual mathematical value for you as an investor. And honestly, the math speaks for itself. When we project these cash flows out over a standard forecast period and discount them back at our 12.39% DAC, our rigorous DCF model outputs an intrinsic fair value of $122.76 per share. Compared to the current trading price in the filings of roughly $87.49, this offers a highly attractive 28.73% margin of safety. Fundamentally speaking, their cash flow generation is significantly outpacing the market's current valuation.
Of course, we always want to do a sanity check, right? So looking at relative valuation, trading at roughly 28 times trailing earnings and 26 times EV to EBITDA actually aligns perfectly with historical megacap tech averages. It shows the company is not trading at distress levels, nor at wildly overvalued bubble metrics. This firmly supports the strong buy consensus rating we're seeing issued across Wall Street coverage right now.
Finally, let's wrap things up with Part 5, Future Growth and Risks.
Looking ahead at the filings, the major tailwinds are obvious. Management's aggressive push into live sports, like the WWE and baseball, is expected to drive ad revenue all the way to $3 billion in 2026. They're also heavily utilizing AI for advanced ad targeting. But as analysts, we must strictly monitor the risks. If content spend balloons past that projected $20 billion budget by 2026 just to fund those live sports, or if they get distracted by major M&A activity, we could definitely see those beautiful operating margins start to compress. So given the incredibly solid financials we've just unpacked, I want to leave you with this question to ponder. With a nearly 29% margin of safety based on current cash flows, is the broader market severely underestimating how much profit Netflix can still squeeze from its 325 million subscribers? As they scale up live sports and really fine-tune that global ad tech engine, the fundamental ceiling for this company might be significantly higher than the current stock price implies. Thanks so much for joining me on this explainer. I really hope this deep dive gave you a whole new lens on how to evaluate market giants.